Welcome to the show, Jonathan. So I kind of want to just dive in with a bunch of questions. I've been following you for many years, and I like the information you put out. I feel like you give real advice, and you're a straight shooter, which is much appreciated in the multifamily space. I've been an investor in small properties like flipping and buy and hold, that duplexes, fourplexes. I know at some point I gotta step my game up because it just makes more sense to own a larger properties, and even investing as a passive investor to get my feet wet in a deal, I think is a great place for me to start learning the multifamily business a little bit better, feeling more comfortable, and just seeing it going through. So on today's show, I really wanted to learn a little bit more about you on expectations for 2022 and 23, because let's face it, the market's been crazy for the last 10 years, and especially the last 3 or 4 years. You got a lot of people jumping into the multifamily business. I think you got a lot of people that are starting to speculate on deals and not really truly underwriting deals. And I've always found you, although we haven't met other than today, that I've followed you for many years now. So I'm really happy to be on the show. So first of all, welcome to the show, and thanks for joining us today. And so a lot of the viewers out there, they're seeing a lot of people that are in the multifamily syndication space, and everybody's looking for deals. And some of these syndicators out there, they make money when they put deals together, so they're kind of rushing deals, it looks like sometimes. And we're at a point in the market where I think there's a lot going on. And how do we actually, I guess the first question really is like, what's your take on the market right now? I know you just recently purchased a property, or you're closing on one, so you're obviously still buying. So there's always deals out there, but what's your outlook going forward right now, and what kind of deals are you looking for specifically in today's market?
So yeah, there's a lot to unpack in that question. First of all, I want to thank you for having me on the show, and I'm really grateful that you've been following me and that you think that I'm putting out useful information. So that's gratifying to hear. So I really appreciate that. Let's see, in terms of where the market is going. I mean, I kind of feel like the market's been on a knife edge for a while, where things have been priced to perfection, by which I mean that you really have to nail your underwriting exactly right, or you're going to get hurt. And yet it's even continued to get sort of expensive beyond that, and make it even more, in my view, risky, because there's just fewer things have to go wrong for things to blow up when you're paying premium prices for everything, and especially when you're paying premium prices for low quality property. So really what you need to be doing at this point in the market is not thinking about the upside of how much money you can make, but think about how you avoid losing money, right? Because I do really think that multifamily real estate is a very, very good long-term asset to be holding, right? And the longer you hold it, the better. But you have to kind of put yourself in a position where you can get through any kind of rough patches that come, right? And I think the longer this bull market goes on, the more likely it is that you're going to see a downturn in your hold period. We've got clouds on the horizon, like rising interest rates, which I know there are people out there who will tell you that rising interest rates are not going to affect demand for multifamily assets, but the problem that they have is basic math, right? Rising interest rates will force lenders to give you less money, which means you either have to raise more equity or you have to offer less for the property. That's just math, right? So it will affect things. So what you want to make sure of is that when you're buying multifamily, you can lock in as long-term debt as possible, but also you're really looking at the asset from the point of view of, okay, I'm not going to get rich on this deal. That's not why I'm investing in it. I'm investing in it because this is a good, safe place to put my money. And it's in the long run, I will make money, but I'm going to get through whatever rough patch is there. So you want to make sure you've got, like I said, locked in long-term debt. You don't have to refinance in the short term. And when you're underwriting, you're looking at, well, what could go wrong, right? And how likely do I think that is to happen? And given that likelihood, then should I still invest in this deal or not? I think a lot of people don't go through that analysis. They just think about the upside and never about the downside. And that's where some people are going to get hurt. I mean, even with a downturn, a lot of people will kind of sail through it fine. but there will be people who are going to get hurt, and the people who are going to get hurt are the ones who were too aggressive, didn't think about the downside enough, only thought about the upside, oversold their deals, made everything rosy, for their investors, and never really contemplated the downside. So they never had they never had a plan for how to deal with it. So that's I think where the market is. You need to be thinking about what's coming, but that doesn't mean like stay out of the market, wait for it to turn. It could go on for another 3-4 years the way it is. You just don't know that. So given that circumstance, continue to invest, but you have to really be granular. And the other thing is you need to invest in high quality assets, because they're going to survive whatever comes much better than low quality assets. I mean, all the data shows that when recessions happen, they disproportionately hurt working class people who are your C tenants, right? Those are the first people who lose their jobs, or the last people to get rehired. Your kind of white collar and highly skilled blue collar people tend not to get laid off early in a recession, because those are the skills that companies need to preserve. They don't want to let all their institutional knowledge and skills walk out the door and then not be able to hire them later. So they hire all the they fire all the low skilled people first. The low skilled people are the ones who are working and living in those C-class properties. They get hit very hard. The whole idea that in a recession everybody goes to C is not borne out in the data. It doesn't even make logical sense, right? So, but you hear this all the time by people who are promoting C properties, right? But if you look at what institutional investors do, they go for high quality because they know that those renters are just going to, in a recession, those renters just keep on getting their paychecks like nothing happened, and they keep on paying their rent. So that's really what you want to do. If you are doing a C property, what I would say is that's got to be like a value add and as fast as possible. And it can't just be like, I'm going to upgrade it from a C to like a better C, or just like update it. I mean, you got to like move it up the value chain to get yourself into that better class of renter, to make sure that whatever is coming down the pike, you've got a better chance of surviving. So sorry if that was a little long-winded. But
no, that was really good. Yeah, I think too, the people that are doing heavy value adds, when they were underwriting their takeout debt, might be surprised if, obviously they're going to, if the rates are higher, they're going to get less proceeds on the refi. Yeah. So maybe there's going to be some issues there. I would probably imagine that we'd see some issues there depending on how far rates move. I do a lot of like what we call DSCR loans, and those are for like rental portfolio, single family rental. And they were like low 4s like a month ago, and now they're like in the 6s right now. Wow. It's just significant. And people buying Airbnb properties, all these they're utilizing these DSCR loans, and even some small multifamily. So I'm seeing like huge, like for example, this gentleman's buying a 10-unit property, multifamily, and we could have got him high 4s a few weeks ago, and now he's looking at like probably 6.5, 6.875 if he wanted to go into a DSCR loan versus maybe. So I said, hey, you're probably better off trying to seek out a credit union for a small deal. It's like sub $1 million type of deal. Very difficult to fund anyways. So I think you're going to see some surprises there for sure. So you explained actually a lot of my questions you answered, because I was wondering what kind of assets you're looking for. So obviously you're looking for the B type of asset probably right now. Yeah. 150 to 300 units is kind of the striking place for you.
I mean, I will look at deals that are smaller than that too. Part of it is like deals have gotten so expensive that it used to be the case that, if you're looking at, 50 units, you're talking about like a $2 million deal. Now you're talking about a $4 million deal for that same 50 units. So, or more. So it kind of changes the economies of scale a little bit in terms of the management that you can get on the property, stuff like that. I've also been shifting what I'm looking at a little bit, because I now have, in addition to like my syndication deals that I work on, I do a lot of JVs. Recently, I've been sort of like JVing with a lot of people, helping them fill out their capital stack. But I also now have an institutional client that I have a JV with, where there's sort of more specific assets that they're looking at. They actually need older assets. So we're kind of looking at older assets. They're looking more from not so much a unit count, but a value, a dollar value, in terms of check size that they need to write. So I've been looking at sort of different assets, as a result of that partnership as well, which has been interesting. That's sort of like a different take on what you're looking for in an investment.
How did that relationship start? Did they just find you and said, "Oh, you look like," and they vetted you out and said, "This guy knows what he's doing. He's sharp. He can underwrite deals."
Well, actually not. So no. So this is a partnership I've been working on for many years, and it actually comes out of sort of out of left field from the multifamily perspective. This is a large Japanese corporation. I speak Japanese. I have a lot of like connections in the Japanese business world, and this I had through just some other networking I was doing, started meeting some of the people who were in the investment division of this company. And a couple of years ago, when they decided that they wanted to dip their toe back into U.S. real estate, they were looking for local operators who could help them on a JV basis. They didn't want to sort of build out a whole, they thought it was better to have local American operators as their partners rather than trying to like internally build this whole function right inside. So since we already knew each other, so to speak, somebody in the company knew me, they said, "Hey, why don't you go talk to Jonathan Twombly about this?" And that's how that partnership came up. This has been in the works for 6 or 7 years, I want to say now, before it's finally kind of come to fruition now.
That's exciting though. I mean, because it opens up a can of a new opportunity where you have a huge opportunity to find assets, and they're looking for specific assets and probably just have a certain return in mind that they're looking to achieve. And how does that differ for you then, as opposed to like a syndication type of deal where you're bringing in accredited investors? Do you like the process better so far because you're just dealing with the institutional type of investor?
It is nice. Yeah. I mean, it is really nice knowing that I don't have to worry about raising the money, right? Because the money, this is more the other way around. It's like the money is there looking for a home. Usually when I'm doing syndication deal, I'm trying to find deals, but I'm also trying to find the money looking for the home, and you can't always match them up, or it doesn't always match up cleanly. There's lots of timing issues. I mean, I can't tell you, we can talk a little bit if you want later on about syndication and kind of how to do it. But, there's a lot of frustrating things with syndication where, sometimes you get like this avalanche of soft commitments, and then like nobody shows up to actually invest because everyone's like, "Oh, well, this came up," or like, "Oh, that guy who's supposed to pay me, I'm still waiting to get paid out of that deal," and they're taking their time about it. Like, so you have all that kind of stuff. It's a lot different dealing with like a large corporation where they're like, we're allocating, X $100 million to this year. We need assets, go find them, right? That's a very different proposition. And it's also interesting because like when you obviously, I mean, I don't have any trouble at this point in my career reaching out to brokers and having them answer my calls, but it's still different when you call them as like, "Hey, syndication Jonathan," versus like Jonathan representing this, multi-billion-dollar Japanese corporation looking for huge assets. Like those are very easy calls. So, and it's actually great for my business too, because now I've got these connections with these brokers, that I wouldn't have had before. Gives me more access to other kinds of deals that might come along for the syndication business.
Curious on when and why you learned Japanese.
So that is kind of a long story, but it starts with I'm actually old enough. Some people probably know this, but I mean, I'm a Gen Xer, so I grew up in the era of everybody thinking about Japan the way that people think about China now, and thinking that Japan was going to take over the world, and they were buying every trophy property in Manhattan. So I actually had a girlfriend in college who was like really gung ho on studying Japanese because she thought this was like the key to riches. And I was at the time like, I don't know, I'm not really sure what I want to do after college, but I know I don't really want to go into any kind of graduate school or anything right away. So why don't I just go to Japan with her? And if I'm going to do that, I better start studying Japanese, in advance. I started studying Japanese. I just really enjoyed learning it. And of course we broke up like naturally. Right. But continued studying Japanese. And when it came time to graduate, we were in the middle of a recession. This was the early 90s. There was like a bad, recession right at the time that I graduated. And I thought, well, there's no jobs here. Why don't I just go to Japan? And so I wound up going to Japan for 3 years. And that's kind of how it all started.
And then you became an attorney after that?
And then I came back and I went to law school. And, the funny thing is I had intended when I went to law school that I would do something related to Japan. That never happened. And it wasn't really until getting into the real estate business that I started actually having some Japanese clients and then, making connections like this at this company that I work with now.
And I see a lot of people now in their syndications, there's this whole kind of like co-GP going on. It seems like everybody is a GP and they partner with other GPs, and that's kind of how they get their feet wet too, right? Because they like, for example, for like me, I have a pretty good understanding of multifamily, but yet I don't want to underwrite deals. And I could either be a limited partner, or I could be maybe on the acquisition side. But what's the real correct way to be a co-GP? Because don't you have to be like included on the documents if you're raising money and all? And I'm just curious on all these co-GPs if they're doing it correctly out there.
Well, yeah, I mean, I think frankly there are a lot of people who are not doing it correctly. I've had students of mine come to me, for instance, and say, "Hey, somebody offered to make me a co-GP, or no, somebody offered to ask me to raise money and they're going to pay me a fee." And I'm like, that is completely illegal, right? You can't, if you're not a licensed broker dealer, you cannot get paid a commission to raise money. And so it's actually, all this co-GP stuff actually comes out of that fact, right? Because when I first got started in the business, there were a lot of people floating around that I would meet at conferences and whatnot who were like, "Hey, I'll raise equity for you for 3%. And they were unlicensed brokers, basically they were doing this illegally. But that was pretty standard. But I think what happened is that, as the business started to get a little more sophisticated and popular, more people started to realize like, hey, you're not actually allowed to do that, right? You can't just pay somebody a commission unless they're a broker dealer. And I think a lot of people like myself then went to the broker dealers and they were like, "Oh, pay me 7%. I'm like, "I'm not paying you 7% of the capital raised to raise money for me. That destroys my economics, right?" So then what happened was they decided, okay, well, let's make you a partner in the deal. We'll make you part of the GP. That way, you're not getting paid a commission. But even that is problematic, right? Because if your slice of the GP is somehow proportional to the amount of money that you raise, then it's clearly a commission, right? So that's also not illegal, but a lot of people stop there because they think, okay, well, that's good enough, and the SEC, like, oh, they're never going to find out about this, so who cares? The people who are doing this properly do it in one of two ways. Either they require their co-GPs to put money at risk. So they're not, so the key is you have to do something other than raising money. You have to be involved in the deal somehow. So you have to be involved in either due diligence, you have to be involved in running the deal somehow. That leads to like a too many cooks problem. So what happens is they say, "Hey, look, you have to put up hard money that's at risk of not closing, and sometimes people require you to sign in the debt also. So doing things that are like, basically in addition to simply raising money and getting a slice of the GP, that's one way to do it correctly. If you're really anxious about this, the best way, sort of like the gold standard of doing this, is that you do your own syndication, right? You raise a fund and then you turn around and you invest as an LP into that deal. So you're not actually getting any piece of the GP at all, but you're getting some kind of, maybe fees from your own investors, in return for what you're getting from the main deal. So that's sort of like the really sort of gold standard way of doing it properly. The problem with that is that you have a lot of expenses involved in setting up your own fund. Your investors are paying your fees on top of the fees you're paying to the sponsor. So it's not like ideal from an economic point of view, but that's sort of legally the best way to do it.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Hi, this is Beau, host of the Investor Financing Podcast. I appreciate you checking out our channel. On this podcast, we talk about real estate, investing, financing, business lending, and acquiring and expanding your business. I'm sure you will find some videos here that will help you build your business empire. There's a lot to see. Take your time and make sure you comment, like, and subscribe. Thanks again. Cool. That's a good explanation, because it just seems like a lot of people probably aren't doing it correctly, and it's all fine and dandy until the shit hits the fan, right?
Well, yeah, I mean, it's all fine and dandy until you're at a real estate conference and the SEC is there and they start handing out subpoenas to like 25 sponsors, which happened a couple of years ago, because somebody very publicly got up on stage and said, "Hey, I'm raising money this way," which was essentially they were just doing it like raising money. Here's your money. Give me my GP. I walk away. See you later. Send me checks. And that's not the way that you're supposed to do it. So you really just are supposed to do it. There's got to be something more than just like, "Hey, I raised money." But a lot of people started out a couple of years ago, just kind of really advertising themselves as capital accumulators, and their sales pitch to their investors was, "Hey, I have the ability to find and vet all these sponsors. You don't have to do this individually on your own. Get on my list, and then whenever I have a deal that I vet, I'll sell it to you." And those people were just, again, getting just a slice of the GP and not doing any additional work, right? So that became a problem. So I haven't spoken to a lot of those people recently, but I'm sure that if they're continuing to do the business and they're trying to do it legally, they're doing something beyond that, like becoming more involved in the deal at an earlier stage, putting up hard money, co-signing on the debt, things like that.
Yeah. Well, that's really, really good advice, because I just always, if I ever get involved in that side, because the number one thing, if you ever raise money, like protect the investor's capital is number one, and make sure things are, by the book, because obviously when everything is going great, people are getting great returns, everybody's happy. And that's the other thing too, is expectations for LPs or passive investors in deals. Like over the last couple of years, there's all these stories. Everybody's talking about all these great, equity multiplier returns, and which is awesome that everybody's doing very well. But it's also, we're kind of going through a historic kind of movement in real estate where people are paying top dollar, and really those expectations probably are not. They're not going to be able to maintain those expectations of like these type of returns. So like you got to convey to the investors, these last couple of years are just, they're not realistic. You're not going to see growth like this, most likely. If we do, great. But realistically, here's what this deal should pencil out to.
Yeah. And I think, what I have been hearing from some of my students and some of the people I work with is, I haven't seen them personally, but because I don't really get a lot of deals from other people, like as LP, I'm not on other people's LP lists because I'm just doing my own business. I don't invest passively with others, but I guess some of my colleagues like to see what other people are doing. And some people have been telling me that they're seeing deals where the exit cap rate is lower than the going in cap rate. And that's an esoteric point that maybe people don't understand, but the cap rate is essentially the multiple that people are willing to pay for the cash flow, right? So, how many times cash flow are you willing to pay for this asset? And so the lower the cap rate means the higher the multiple that you're willing to pay, right? So the lower the yield. It is a baseline rule of underwriting that you always underwrite to a higher cap rate than the one that you bought at, no matter what you think is going to happen. Because there are certain circumstances under which you might believe there's going to be cap rate compression, but you're always going to underwrite to a higher cap rate and hope to be surprised, that it's going to be actually lower. And you would, even if you believe the cap rates were going to compress for some reason, like for instance, you're buying at the bottom of the market when cap rates are expanded, and you believe there's going to be natural, compression, which always happens in a cycle. You might believe that that's going to happen, but you wouldn't tell your investors that's going to happen. What you're seeing now is people telling their investors, like in the pro forma, we're going to exit at a lower cap rate than we're going into because we believe the market's moving that way. And they're doing it because the only way to make the deals show the kinds of IRRs that investors have been trained to see is to do that, right? So I feel that's irresponsible. I would never do that because frankly, I just don't, my view is under promise and overperform. That you're setting yourself up for overpromise and underperform scenario in that situation. I just think it's dumb. But if people are so desperate to get their investors into deals that they're willing to promise them the sun, moon, and the stars, investors beware, frankly. But I think that's whether it's ethical or not, I don't know. But I think it's like as a business practice, it's dumb to do that. You're just setting yourself up for a bunch of angry investors.
As a limited investor, a limited partner in a deal, what's the most important thing to really look at? Like, just expectation wise, is the IRR, because that's what can you kind of like, if you were an LP vetting you out or vetting any syndicator out on a deal, what can you kind of walk through, like the numbers you're looking at, like a cash on cash return, like realistic expectations? And I know like everything is hypothetical until it actually goes full circle, but where would you tell them, how would you tell them to kind of vet a deal?
Well, so before I get into that, I'd say you should vet your sponsor, right? And the way that you should vet probably the most important thing. There's a couple of important things that I think that people should vet their sponsors with. They should try to talk to other people who have invested with that sponsor before, right? I mean, I should try to talk to the sponsor themselves, but they should also try to talk to the sponsor, people who've invested with the sponsor. And when you say talk to the sponsor themselves, you should make sure that you're talking to the person who's actually doing the deals, not the guy who's like faces on the picture. Because oftentimes, people have become very sophisticated. A lot of the well-known syndicators out there are really just raising money, right? They've got a podcast, they've got a website, they've got a whatever it is, and they're just sort of like the face of the program that's bringing in investors. They're not actually underwriting the deals. Maybe they started out doing that at one point, but they've moved on. They've gotten more sophisticated in terms of like how they structure their business and how they grow their business. Talking to that person is not necessarily going to be all that helpful to you. So you got to figure out, is this the guy who's really doing the deals or not? So talk to the right person is the first thing. Second thing is try to get to talk to some people who've invested with that person, right? And what you want to ask them, probably the biggest question is you want to ask them, how is their communication? Because that will tell you a lot, right? Do they tell you bad news or not? Or is everything always rosy? Or, when bad news happens, how are they characterizing it? Are they saying, yeah, we screwed up, but we understand it, and this is the plan to fix it? Or do they blame everybody else? It's somebody else's problem. It's the bank's problem. It's the market's problem. It's the manager's problem. It's somebody else, right? If you encounter somebody who's like that, then that's probably, you're not dealing with like somebody who's really got your interests in mind, right? You also want to find out if they've done capital calls before, because that's a good, there's always going to be deals that go bad, right? But you want to, hopefully not, but you want to find out, like, have they done a capital call before on their investors, and what were the circumstances under which it happened, right? Was it just that they underwrote the deal wrong? Or was it that really something that could not be foreseen happened that led to the capital call? And really what you want to hear from somebody is like, we've never made a capital call because we used our own money when that happened, right? So if somebody asked me, have you ever made a capital call, Jonathan? I'd say no. I'd say, but I had one deal where I could have, I was entitled to, but I didn't. I didn't want to make the capital call. I used my own money to fill the hole. And then, when we sold the deal, I was paid back for that money. But I took the hit, right? So that sort of tells you that somebody is like got your interests in mind, because they don't want to go to you if they can't, if they can help it. They don't want to go to you and say, give me more money because we screwed up. My view is like, if I screwed up, I should, bear it. And if I possibly can, and, and make it right. So, but you have to try to, I think what you want to suss out before you even get to the deal is like, is this sponsor somebody who really takes their fiduciary duty to you as an investor seriously? Are they putting you first? Or are they just in it for the money and they just see you as like just another, $50,000 chunk just to fill out the capital stack, and they just don't really care. They're just like, do a deal, get my fees, get paid, go have a fancy steak dinner. And, investors, well, yeah, you'll make money because it's multifamily and it always works out well. And you have nothing to worry about. Like when you talk to people, you want to find out what their view is. And if they pitch you a incessantly rosy picture, that's not really somebody you want to deal with. You want somebody who's going to be straight with you about the things that could go wrong, what they plan to do if they go wrong, what they've done in the past when they went wrong, right? That sort of thing. So that's what I would say to try to find out about sponsors before you get into the deal. Then the deals themselves, basically what I'm seeing right now is deals are penciling out in sort of like mid-teens IRRs. The deals I've been involved in with sponsors that co-sponsors that I really trust, the people I think are really smart, that's where they're coming out. They're coming out at sort of like, 1.6, 1.7 equity multiple over 5 years. They're talking IRRs in like 13, 14, 15 range, right? And if you're seeing more than that, if you're seeing people promising you like 20 IRRs or whatever, that there's got to be a real story there that makes sense. Like there's got to be some kind of like they bought this asset, something was mispriced, they stole it, they got it out of a foreclosure. There's got to be some, it was some mom and pop that didn't know what they were doing, and they actually the rents are $500 below market. Like some real, like there's got to be a lot of meat on this bone left to make those kinds of numbers, given where pricing is right now. So I would, if you see it, someone's pitching a deal that's in that kind of like, this is a nice return, nothing spectacular, but it's decent. I mean, it's I'm happy to get a 13 IRR. Like that's, I think, pretty trustworthy. And chances are you may do better in that deal because maybe that sponsor, if they know what they're doing, they're kind of under promising, right? And just maybe they do think the deal's going to do better, but they're not going to come and tell you their best case scenario. But when you've got people pitching these like super juicy numbers, that's something to watch out for. And the other thing to watch out for is when you see sponsors who are raising additional capital so that they can pay their investors, basically saying, hey, we're going to pay you back with your own money, right? But we'll pay you a return on that money that we're paying you back with. That sometimes they'll characterize this as a reserve, right? You always want to be reserved on the property, and that makes sense. But you kind of want to make sure that like they're not raising extra money so that they can pay you your preferred return essentially out of the reserve fund, right? You want to be paid out of the profits, not out of your own money. This is essentially a way of sort of kicking the can down the road. They're saying, oh yeah, well, when we sell, we'll all true it all up and everybody will be happy and you'll make money on the money that we paid you a return on and stuff. But I would rather see a deal where they're like, well, look, we don't actually think we're going to make the preferred return in the first couple of years because the numbers just don't bear it out given where prices are. But when we sell, we will catch you up on the preferred return. So this is your end number. This is not your yearly cash flow number. This is your total return number. But when you see deals where people are saying like, oh yeah, no, you're going to get an eight pref from day one because we've raised extra money so that we can do that. Like that's a little sketchy.
And it's probably like if somebody's out there listening right now, like, and they're like, hey, I make a good income. I'm a surgeon, I make $1 million a year. I need somewhere to park my money that's going to return the highest, be best use. And potentially there's some tax savings and, through cost segregation, I might be able to take advantage of some of the tax benefits. But really, for somebody like that, they would probably be like, maybe go through, like, I know you have some courses that you teach and some programs. Like, even if you just want to be a professional limited partner, it's probably advantageous for somebody like that to go through and get educated on like the underwriting process, and just so they know enough and they're just not putting their money into a deal and they're not asking the right questions because they don't know the questions to ask in these type of deals. I would probably think that would be pretty smart if you wanted. I mean, ultimately to me, and this is what I've been talking about on the previous shows, I hope at some point in my life that I have enough cash that I can just deploy with good sponsors. That to me, that's the best place to be. because I don't have the stress of performing.
Right.
I'm just picking the best horses to bet on. Like that's where I think people would really want to achieve to eventually, right? Like, doesn't that make sense? Like,
Yeah, unless you want to go into the business yourself, right?
Yeah.
So I agree with you. But if you're, I mean, like my background is I was a corporate lawyer. I really hated it. I wanted to get out and do something else. So I figured out how to become a deal sponsor. But for a lot of people, who like don't hate their jobs, you're a surgeon, you like what you do, you want to do it until you can't do it anymore, physically, and you just want to invest passively with people, then yeah, I mean, I think that makes total sense. You don't want to go out and buy your own property and then have the headache of managing it. I used to call this and not to cast aspersions on dentists, but I used to call this like the 4 dentist deal, right? Where you had like 4 dentists making a lot of money, and they're like, hey, we have all this money, let's go buy a building together, right? And we're smart, but we run a dental practice. How hard can it be to run a property, right? And then they run the property into the ground and they sell it at a loss, right? Because they don't really, they underestimate the complexities of running a property and just the time commitment and the headache of it. So they lose money on it, and then they get turned off real estate. Like someone like that who doesn't want to focus on real estate should just look to buy passively. I mean, to invest passively with somebody else. And that's the great thing about syndications, is that it offers that opportunity. And frankly, that like 4 dentist deal doesn't happen as often as it used to, because I think because syndication has come into its own, people now see that there is this opportunity to invest passively with others, but it didn't used to exist, right? So that's the good side of syndication. It's created this passive opportunity for people who really don't want to be bothered investing directly in real estate. But then there's the other side of things, like, if you want to do this as a business yourself, because this is what you love, then, I offer a lot of courses around that kind of thing. But even as a syndicator, sort of my goal is sort of similar to yours. Like, you want to just do your business and put money passively into somebody else's deals. I always view syndication as kind of like the means to an end of building my own net worth to the point where I don't need investors anymore, right? I'll just go buy property with my own money and run it myself. And then I don't have the pressure of performing for investors, right? And I don't have the pressure of raising money anymore. And I can just run the properties and just live off that, and I know how to set up a system for that so that I'm not making myself crazy. So I can do that pretty passively myself, right? But because I know who to hire, know how to oversee them and stuff like that. So that's for me the ultimate goal. And the other is like so syndication is sort of like a way station to get to just being on your own,
Yeah, I mean, I look at it like you could just build yourself up where you could own, even depending on your financial needs, right? Some people could go out and buy a 100-unit apartment complex, and that could provide enough cash flow where they didn't need to work anymore. They could live off the cash flow, and so you just got to figure out where you are with where you're at in life, and then work. Obviously, you can make the most money being the operator usually. I mean, because you can leverage a little bit, but you're also you have a lot of the risk because everybody's looking at you to perform. And I want to be able to sleep at night too. Like,
yeah,
that's
totally.
Yeah.
So, and listen, I think a lot of people too. I mean, we've been lulled to sleep by now essentially it's almost a 15-year bull market in this asset class, and there are people who have literally never experienced a downturn as an adult who are in the business, either as a sponsor or an investor. What they don't understand is coming is what I experienced as a lawyer, which is that when a recession hits and investors start losing money, they start looking for somebody to blame. And if you're the sponsor, you're the one who they're looking to blame, right? Even if it's not you did everything right, and just the economy went sour, and it's not your fault, you're gonna have people who are looking for a scapegoat. And there's going to be plaintiffs' lawyers out there who are now going to be looking around saying, wow, some of these bigger syndications, there's enough investors in there for me to do a class action, right? And so you're going to get hungry, plaintiffs' lawyers thinking like, hey, I'm going to go after this deep-pocketed sponsor, and they don't even have to prove that you did anything wrong for them to extract a big settlement out of you in a nuisance case. right? So it's, as a sponsor, it's really important that you do everything the right way right now, because there's going to be a downturn at some point. And when it happens and people lose money, you know, you want to make sure that you don't get sued. And that's going to come back to this communication issue I talked about before. Like, just to borrow an analogy from medical malpractice, you know, the doctors who don't get sued in medical malpractice are the ones who had good communication with their patients, because their patients like them, and their patients are willing to, if they're treated well, the patients are like, yeah, well, people make mistakes, right? So they're not going to sue. When they are treated by some jerk, right? The jerks are the guys who get sued. So if the jerky sponsors are going to be the ones who, you know, who don't have any kind of like real relationship with their investors and just treat their investors as a means to their own enrichment. Those people they're the ones who are going to get sued. But the ones who take time to build relationships with their investors, always tell them the truth, communicate well with them, tell them bad news when it comes up, you know, don't hide things. Those people will be okay, because, you know, treat people decently, they treat you decently back in most cases.
Yeah, and I think it's important too to probably, you know, have a conversation log of some sort where you know, or here's the emails that have been sent through this relationship, and document, like, yeah, we did say we were having issues with, you know, the turnover of, you know, these units, because it was a lot more work than anticipated. And quite frankly, that's where probably a lot of the issues come into play. You know, I can speak on the fix and flip business, is that, let's face it, managing construction and construction costs and construction time is probably the hardest thing to manage, because you're at the whim of these contractors. And right now everybody's short staffed, and the cost of everything was going up. And it's just, I had a small property, and I got to do a few things to it. And it's like overwhelming, like the costs now, what they are today versus like 2 years ago. So people just need to be aware. And yeah, I think you're right. Communication at the end of the day. And sometimes in the loan business, I have to be the bearer of bad news. Yeah, on these type of loans, we can't lock until we go to docs. And unfortunately, your rate was supposed to be a 4.25, and now it's a 5.8. I have no control over it, but all I can do is communicate, like, listen, your rate's not locked in. We're in a moving rate environment, and this is what it is. So I agree with you 100%. Even when conversations are difficult, it feels so much better to just get it off on the table. Hey, we're having issues here. And when I was younger in the loan business, I would take it internally and I would stress on it. I would never just like tell the borrower, the customer or client, hey, this is what it is. And it, you know, after you tell them and you just explain, it feels good, first of all. And then I'm going, why did I hold this back for a few days? Because I was so nervous to tell them. And really, it's not me. It's just, you know, It's what's going on with the economy and the world. So that was really, really good advice. I love your transparency, which I think is very important in the business. So where can people find out more information if they wanted to be potentially like a limited partner eventually in a deal? Is there a place you send them, or you just send them to your main website? If they wanted to learn about being an operator and starting a syndication type of business, or just, you know, buying their first multifamily property, do you have two different places you like to send these people?
I do indeed. So if you would like to get on my investor list, I only deal with accredited investors. So, but if you are accredited and you want to get on my list, please just Google Two Bridges Asset Management LLC. It's easier than me explaining the URL. So Google Two Bridges Asset LLC, Two Bridges Asset Management LLC, and you'll see an investor form you can fill out right there. And if you're interested in learning how to do deals, whether it's as a sponsor or just because you want to learn how to buy a deal properly on your own, then you should go to multifamilylaunchpad.org/join, and it'll explain my main program and all of the stuff that you get, all the materials and the calls and whatnot. So multifamilylaunchpad.org/join.
I think I like talking to a lot of my friends that are investors but don't invest in multifamily, and they want to. Their roadblock is the underwriting process. They get intimidated with these spreadsheets. Is there any tips you have for, like, even though I do loans for a living, I hate spreadsheets and I always feel intimidated. And I started using this cool app online for like single family, and you know, it's super easy to use and I could just put it as cloud-based. But what's your advice for somebody like me and many of my friends that are like, I really don't want to go in the weeds with these spreadsheets?
You mean for somebody who is looking to buy a deal themselves, like a multifamily deal?
Yeah.
Well, yeah, I mean, it's a little bit more weedy, but I do have a mini course that
Mhm.
that kind of walks you through how to do this, and it comes with with basically what I call a quick and dirty underwriting model. So it's not, I give you like my full, whole underwriting model, which is multi-page and like, if you really want to get into the weeds, but there's also a quick and dirty one where in about like 10 minutes, you can kind of figure out like, okay, is this something that is worth pursuing or not? Right. And so I walk you through how to use that. That program is called uh, Underwrite Right. Oh, actually, you know what? No, that sorry, there is an Underwrite Right program, which is a mini course on underwriting. But for that quick and dirty underwriting thing, there's a course called Backroom Deals, which is called Get the Backroom, How to Get the Backroom Deals. If you Google that, you ought to be able to find it. But that walks you through how to find multifamily deals, and then you get the quick and dirty underwriting tool to just help you decide, like, is this something I should pursue or not, without getting into like a whole underwriting. So this is really good for people who are looking at like, 5-unit, 10-unit deals on their own, not looking to syndicate. They just want to like figure out how to get the deals and how to figure out if it's a good deal or not. That's it's like $47. It's nothing. So
Yeah, no, that's kind of what I want, because I want to
Yeah.
start buying, like, I want to start with a smaller deal and do it myself or with one joint venture partner. And that makes sense to me. Is just get a quick and dirty, like, take a look. I could, it takes me 20 minutes to go through it. I go, okay, nope, this isn't a deal. Nope, this isn't the deal. And then, okay, this one looks like a deal. Then I can get an advanced spreadsheet, and then I can have somebody else, hey, take a look at this, make sure all my numbers look right. And,
Right.
then I think that's the way to build a confidence in the space. Cause my friend and we'd always talk about it. We're like, God, just multifamily, just this whole underwriting process, it seems overwhelming. I know, like, once obviously on the loan side, it's a little bit different. It's kind of easy to figure out the loan side, but when you're buying something, you got to put the buyer cap on. It's a completely different process than underwriting to lend on. So anyway, really appreciate your time. This has been a great conversation, and I told you 20 minutes, we went almost an hour, so that seems to happen. But yeah, it was great. You provided some really great insight on this whole business, and really enjoyed the conversation, so thank you.
Well, you're welcome. And I can be a little long-winded, I guess, sometimes. So sorry about that. But really appreciate being on the show, and looking forward to staying in touch. And
All right.
yeah,
Thank you so much, and
Thank
thanks
you.
everybody for watching. I hope you enjoy this episode as much as I did, and we'll see you on the next one.